Well, welcome back. This is David Bickerstaff again. I'm a consulting actuary in the Dallas-Fort Worth area. In this video, this is a part two, a continuation of a demo I'm doing of a model that we put together to determine the effectiveness of a specific reinsurance plan for a proposed captive. In this case, in part one, we defined the captive with a $5 million premium, some other parameters. We defined the swing rated reinsurance plan, and then we ran a simulation of 10,000 trials of the losses of this captive, including ceded losses in the plan, and associated with those ceded losses, which was a 750x of 250 layer, we have a distribution of swing rated ceded premiums. And this is what we came up with. And we had an option to define the losses using ALAE on a pro rata basis, and another option of defining the loss with the sum of ALAE plus indemnity, in other words, ALAE combined. So this was the two distributions we came up with, which showed at about the 91 percentile, these lines intersected, and this area above the blue line here represented risk transfer, and this area down here was what the captive would pay as sort of a premium above what the expected losses, ceded losses would be. Now, the question is, what is fair? Is that 91 percentile too high or too low, or how do you determine that? Well, one way that has been put together in the last 8 or 10 years to give sort of a metric to measure how effective a reinsurance plan is, and it's called the expected reinsured deficit, ERD for short. And they take the terms and the expected loss experience over a period of time, which we've done here, and we calculate what that ERD score is. So here in this continuation video, we're going to take a look at what this ERD score does. What you've got to do to calculate this score is you have to discount ceded losses to present value using an interest rate. In this case, we use 2.5%. You've got to have a distribution of payout for losses expected in 1 year, either a report year or accident year, what percentage you expect to be paid in year 1, calendar year 1, calendar year 2, 3, and 4. And then in addition to that, you have to account for the fact that claims paid in the first year or two are going to be less than the overall average, and vice versa. The claims paid in later years are going to be expected to be higher than the overall average. So what we've done then is, to account for that, is to assume that claims paid in a calendar year 1 will have an expected value of half of what the expected value is for the entire year. And what we did in the first part was we assumed that the average indemnity would be $200,000 at the $1 million limit for the entire year, but for the first year we use 50% of that, 100,000, and then 150,000 for the year 2, and so forth. So that being a preliminary estimate of the relative severity, we then fine-tune those numbers over here so that everything is in balance, so that the sum of paid claim count distribution and the severity, relative severity, the product of those two equals the paid amount distribution, which is more than likely was used in the original actuarial report to come up with the present value discount in the first place. So these are the factors used in the ERD calculation. So when we run 10,000 trials, one of the first things that we do when we have a claim is to randomly select what year that claim is going to actually be paid. If it's in year 5 relative to the accident year or report year, we expect that's going to be 1.5 times the overall average, and so we sample from a distribution which has a mean, instead of 200,000, a mean of 300,000, and so forth. All of this comes out to be a present value of 0.9288 using a 2.5% interest rate. Given those parameters, now we're ready to run a simulation. Another simulation, this time using present value of both ceded losses and a present value of ceded premium. So you have a reinsurer deficit in a year where the actual present value of ceded losses exceeds the present value of ceded premium. Now, at some point, I don't know who invented this score, but it's fairly common in use, and the threshold, the benchmark used for this score as defining a passing score is a percentage of 0.01 or 1% or higher, that the ceded losses at present value exceed ceded premium at a point of 1%. This particular set of terms that we started out with in our first video turns out to have a score well above the passing 1% mark. And using ALAE on a pro rata option, it's like 6.8%. And at an ALAE combined option, it's about 9%. So if to whatever extent one believes that this is a good score, and I don't have any reason not to believe it, or this is a good measurement or good metric, then this particular set of terms would pass well, in flying colors over the benchmark. Now, I want to go back to the beginning and modify one parameter. What if this entity, instead of having a $5 million premium level, let's say it was 10 million, double the size, and we leave everything else exactly the way it was. We don't change a single thing except you just double the size. When we make these calculations, we have twice the number of expected claims. We're going to run the simulation again. This time it's going to take a little longer because we got twice as much volume. We've sampled 3 million claims, and it took about 5 seconds. Now we're sorting these buckets in ascending order. Now we're coming over here and we're going to construct the probability distributions. This is where we left it with the $5 million volume, and using the ALAE pro rata, let's repopulate this thing using a $10 million volume. And you can see that these lines intersect now at about the 95% point instead of the 91, and the level of risk transfer has shrunk, simply because we have now assumed that the entity has twice the premium volume, and because of that increased volume, the distributions have narrowed quite a bit. In fact, if we were to recalculate what the ERD score is using these same percentages, run that simulation again, this is where we left it, 6% and 9%. If we recalculate it now using the $10 million premium volume, the ERD comes down quite a bit, 2.8 and 4.4%. Without going on back and redoing this, I can tell you that if we went back and doubled the volume one more time to 20 million, this ERD score would be right on the bubble of 1%, either just below or just above that so-called passing score. So the point is that the volume of the entity has a great deal of influence in how you can assess the level of risk transfer in a particular set of terms. Now, this is the end of part 2, and here's my contact information again. In the final part of this demo, we're going to address a set of reinsurance terms on a fixed premium basis as opposed to a swing premium, and to see what difference that will make in the overall assessment as to how much risk transfer there is. So join me then, and we'll talk about a fixed premium plan. That's going to be in part 3, and we will see you then.